Hey, everybody. Hope you had a great Thanksgiving. Happy holidays. I wanted to dive right into it this month. We've got a lot going on, a lot to update you with. Since our last update in November, we did see conforming loan limits increase. We're up to 726.2. Represents about a 12.2% increase in conforming loan limit, and obviously reflects the fact that real estate has appreciated over the last 12 months. So as the homes get a little bit more expensive, it is only logical to believe that we might need to borrow a little bit more money to finance those purchases. So, conforming loan limits went up as we've been over in the past. Conforming loans are a little bit easier to qualify for once you cross out of that conforming loan limit. Uh, Cross over that, borrow more money. You're now talking about portfolio loans, typically jumbo loans, which do normally require slightly higher credit scores, higher down payments, a little bit more strict debt to income ratios, etc. So, always good to see those conforming loan limits increase. We also saw the Fed meet this week as expected. They raised interest rates a half a point. They've been very open about this, very clear on what their plans are. At the end of the Fed meeting, they did also announce that they plan to continue these increases, albeit at a slower pace, moving into 2023. We're kind of expecting a quarter of a point increase at the next meeting, which will be in February. And they're targeting the Fed funding rate to be somewhere around 5.1% at some point in 2023. They did also comment that they expect the Fed funding rate to be around 4.1 and by 2024. So while they do plan to increase in the short term, long term, they plan on retreating a little bit. So they did remark as well that unemployment is likely to increase, and the GDP is likely to decrease. So their forecast for U.S. GDP has been pulled back a little bit. So, the word floating around my head is recession. We've heard that a lot. We'll see what happens. We did get some consumer price index numbers about a week ago, and saw that the rate of inflation is slowing. So that's a great sign. Again, the target rate, at least for the Fed, or at least for Jerome Powell, seems to be around 2%, maybe 2.5% for their goal rate of inflation. Right now, we're down to 7.1 as of November's numbers. And these are the numbers we just got last week. The previous month, we were about 7.7%. So we're moving in the right direction. We're making up some ground, but we're obviously not where we want to be. If our goal is 2 to 2.5, and we're at 7, a little over 7, obviously we've got some work to do. Generally speaking, we do expect, obviously the Fed came out and said that they're expecting the Fed funds rate by 2024 to decrease. Most large institutions, Fannie Mae, Freddie Mac, Mortgage Brokers Association, National Association of Realtors, have all predicted interest rates to fall in 2023. Generally speaking, I believe that to be a widely shared belief by most economists. And, reason being, obviously, if we see a recession, we've talked about that to great length. Even if we don't see a recession, even if we just see markets kind of stabilize a little bit, I believe interest rates will fall. So one of the indicators that we believe that's kind of showing us that interest rates maybe should be a little bit better than where we are today is the 10-year U.S. Treasury bond. So this is something that mortgage lenders have paid attention to for decades. When I first got into the industry, mortgage-backed securities were not readily available online. You couldn't really find prices online. I'm dating myself. We used to carry pagers that had financial information, but nonetheless, we didn't have access to all the information we had today. So we really paid attention to the 10-year U.S. Treasury bond. Traditionally, the margin between the 10-year U.S. Treasury bond and the average 30-year mortgage interest rate has been about 1.7%. and this is going back for, several decades, about 1.7%. Currently, we're sitting at about 2.7%. So current 30-year fixed interest rate is somewhere in the low sixes, and the 10-year U.S. Treasury bond is trading at about 3.5%. So we've got a wider margin currently. A lot of people are kind of guessing, why would that be? Why is that? And a lot of it has to do with market instability. So obviously we've seen quite a bit of appreciation over the last couple of years. A lot of people think that, and we've already seen to some extent, at least some markets in the United States have been correcting. We've seen the rates of appreciation slow quite a bit. Currently in Chicago, we're sitting somewhere around 3%, 2.7%. Some markets have even decreased, some markets out west, some markets in the south. Anywhere where you've seen really rapid appreciation, the pendulum is swinging back the other direction a little bit. So those are correcting. Once these markets have settled, I believe that margin between the 10-year U.S. Treasury bond and the 30-year fixed will narrow, and we should see, even all else being equal, we should see mortgage rates improve a little bit. So we'll keep an eye out for that. Some predictions for 2023. We're still seeing, at least in the Chicagoland market, prices hold strong. Properties are still moving in 43 days, which is crazy. Obviously, we are seeing less transactions, and this is actually helping keep prices steady or stable. So we've got fewer sellers. Obviously, we have fewer buyers because of interest rates being up, curbing demand, but it's also curbing supply. So as long as that supply and demand kind of stays in balance, prices remain solid, we've got a stable market in any market, but specifically talking about the Chicagoland market at this point. So I do expect perhaps a pickup in volume as we see interest rates perhaps dip at some point in 2023. I would expect, obviously, buyers to come back into the market, and then sellers will be more willing to sell if there is a shallower drop from, if they're selling a house and their current rate is in the 2s or 3s, and they've got to buy a new house, and maybe if they can get a rate in the 5s, they're a little bit more willing to do that than buying a new house in the 6s or the 7s. So I would expect a little bit more willingness on the part of sellers to list properties, a little bit more selection, a little more inventory. And again, buyers are always there. And certainly with lower interest rates, buyers will be out even more. So we'll see what happens. I should have year-end numbers for the January update. So I look forward to sharing those with you. Those are always fun to explore. Let me know your thoughts. Let me know your questions. I look forward to hearing from you. Happy holidays. Stay warm, and I look forward to talking to you soon. Have a great day.